Welcome to a special edition of Behind the Markets from Lean's Lodge. I think today's episode we're going to call Fishing and Finance. We got Jim Bianco, who is the founder of Bianco Research, Jack Farley from Blockworks, the Forward Guidance podcast. I'm Jeremy Schwartz, the Global CIO at Wisdom Tree. We're going to talk about fishing here in Maine, but what's happening in the economy, a blockbuster week. Gentlemen, welcome to Behind the Markets. This is our first episode broadcasting live from a deck overlooking a lake in Maine. Now, we're going to talk a lot about the economy and what's happening here. Jim, maybe we'll start with you. Give us your read. We've had a lot of reports this week. The market's been responding pretty well. Give us your take on what's happening in the economy.
After some data that was a bit inconsistent and weak at the beginning of the month, highlighted by the payroll report being less than expected, the data did somewhat rebound as we moved throughout the month. We had some good initial claims numbers, meaning the number of people filing for unemployment insurance fell. We had a good retail sales number as well, saying that spending is still continuing. And the inflation data came in at least at what people expected, if not a little bit below in terms of producer prices, so that inflation wasn't a real problem. So the market, after getting a period of indigestion at the beginning of August, did start to rebound on some of this better data. And now we're starting to see interest rates kind of creep up as well.
Jack, you're talking to a lot of people on Forward Guidance. What's your sense of what's going on?
Well, I think that I'm going to take and borrow and steal an insight from Peter Bookvar, who's inside as we record this, that bad economic news is now bad news for the stock market, and good economic news is now good news for the stock market. Over the past 2 years, maybe a year and a half, good economic news that shows strong nominal growth, whether it's spending or investment or employment, was taken as a bad news in the stock market because that's inflationary. I think now we could be in a regime, and probably are, where bad economic news is going to be bad for the stock market because, oh great, bad economic news is going to drag inflation lower, but it also could cause a recession. So I think there is definitely a growth scare, and I'll say that the unemployment rate going from 4.1% to 4.3% in 1 month, it's not great. Jim, what do you say about that?
And Jim, the context, we have Professor Siegel on here every week. We'll hopefully get some comments from him this week, hard from Maine, but he came out aggressively saying the Fed, with 4.3 unemployment, is past their employment mandate. And he thinks inflation is sort of 90% there. So he thinks they should be cutting aggressively to neutral. What's your view on Siegel calling out the Fed, and where is the whole cycle in your view?
You know, there's always what the Fed should do and what the Fed will do. So I'm in the will camp that they will be cutting interest rates in September. I think they're going to cut by 25 basis points. The big thing that we'll have to look at is next week, at the end of next week, is going to be the Federal Reserve's Jackson Hole meeting. And I think that Jay Powell will use that meeting to kind of frame the discussion of what they want to do with interest rates over the next year or so. Yeah, I think they're going to cut rates. The market is pricing in the idea that there might be 8 25 basis point rate cuts for a total of 200 basis points. That might be a little aggressive. So I could see that the Fed might come out, and, or at least Jay Powell in that speech, and try and say, yeah, I'll cut in September, but don't be looking for like a cut every single meeting for the next year. There is only 8 meetings a year. So basically what the market is pricing in is a cut at every single meeting for the next year. And the reason I think that is the data is somewhat cloudy. So let's take real quick the unemployment rate rising to 4.3%. That triggered what everybody on Wall Street is talking about now, which is the Sahm rule, which is the 3-month average of the unemployment rate moved 0.5% above its low of the previous year. That's supposed to tell us that we're in or very close to recession. Well, the issue with the Sahm rule is, or the assumption with the Sahm rule, is that demographics are supposed to be stable and predictable. Claudia Sahm, the inventor of the rule, has said that the reason that the rule might have been triggered is we have an excessive supply of labor. Well, that's a nice way of saying, I should say, that we've had a lot of people come over the southwest border that are unemployed. And those people are starting to get picked up in the surveys or in the Census Bureau's estimates, and that excess unemployment is starting to be the unemployment rates to rise. If that's the case, and we're talking about a change in labor supply, that doesn't necessarily mean the economy's slowing, as opposed to the traditional answer, if demographics were stable, that we're just seeing a slowing of the economy, which is why it's not producing enough jobs.
Yeah, so for our audience, the economy could be net adding jobs, but if the number of workers, the number of people in the labor force increases more than that, the unemployment rate can still go up. Just so Jim, I've heard that argument. I don't know if people coming across the border into America and they are part of the labor supply, but are they counted in the household survey? Because doesn't the household survey, they have to call people on a landline telephone? Like, are people, they just crossed the border, like, are they setting up their telephone lines? You know what I mean?
No, yes and no. No, they're not. They're not calling migrant shelters and asking people if they've got jobs over there, but they are getting. They take the data that they get from the survey and they adjust it according to the census report. And the Census Bureau has been increasing the amount of people that are in the country and what cohorts, what age cohorts, and what cohorts that they're in. And by taking that data and applying it to those changing cohorts because of the increase in the population, that's what's causing the number of people going up. So it's a twofold process. It's not just we surveyed the world and we're not finding any migrants that are telling us that they're unemployed. It's we're surveying the world and we're also getting this data adjusted by the new Census Bureau data, which is showing certain cohorts are increasing rapidly in size. And that's what's leading to kind of the increase in the number of people that are unemployed.
So I guess there's two issues. There's this unemployment level and where we think it's going. But as Siegel points out, in the Fed's long-term dot plot, their long-term estimate is 4.2 when their neutral rate is 2.8. So we're past their unemployment mandate.
Right.
And so that would say you should be accommodative, but we're kind of quite restrictive. And then the question is, inflation is coming down, but you think inflation might be not coming down. Let's hear your case on inflation.
So Wall Street loves airplanes. So Wall Street loves airplane metaphors. And there's the hard landing metaphor, which is a recession, the soft landing metaphor, which is kind of a slowing economy. And there's the no landing metaphor, which is the economy's growing at its potential. And I'm in the no landing camp that the economy is still growing at its potential. Now, it has its moments when it grows better and it has its moments when it grows worse. It doesn't grow consistently at that pace. And then some sort of industries will grow better and other industries will grow worse. So I think the economy is no landing. It's kind of hanging in there and it's doing okay. If the Fed is not too careful and they wind up saying, well, we got to cut rates aggressively because we think that things are slowing down, they could take an economy that is at potential. They could take inflation, which is at 2.93%, and start stimulating things. And they could wind up with inflation higher than what we're seeing. Now, as I like to say, I'm not talking about 8.10 or Zimbabwe inflation. I'm talking about 3.5 or maybe even as high as 4. And that would be very problematic for the Fed. So let's make sure that when I say that inflation is going to go up, that it's not going to be some ridiculous number that I'm talking about.
Yeah, you're talking about 3 to 4%. By the way, I read recently, I think Zimbabwe, a long sufferer of extreme hyperinflation, I think that they just instituted a gold standard, so monetary nerds will be looking to see how that plays out. Jim, so I thought the no landing scenario was one where nominal growth, which is real growth, and inflation are both kind of out of control and very high. Wouldn't you say that the situation of the economy over the past, let's say, year and a half, or we can even say two years, where inflation has fallen and nominal growth has fallen, but inflation has fallen more, so real growth has rebounded. Doesn't that kind of smell and look like a soft landing?
It can. I mean, you're right that from where we were 2 years ago when we had 9% inflation, we've come down a long way. Question is how much more do we have to go? And what your question is implying is getting to the question about real interest rates. Real interest rates are, if you take the interest rate minus the inflation rate, what's left over is what we would refer to as the real rate. A lot of people are looking at real rates. Let me use the Fed funds rate as one example. So, in other words, the 5.25 Fed funds rate minus roughly the 2.7 or 2.6 PCE rate gets you about 2.8 on real, just so you know where that number comes from. That's a 15-year high, and that is very, very restrictive. However, the last 15 years, or at least until from 2009 to 2022, we had quantitative easing, and that real rates averaged minus 1%. In the 30 or 40 years before 2009, when we didn't have quantitative easing, real interest rates average 2.6%, and they're 2.8 now. So if we're in a non-QE period, you could argue, no, this is about where real rates should be. We're just not used to it because for the last 15 years, we've been used to zero to negative real rates because we were in quantitative easing. So that brings up the whole debate about where is the neutral funds rate.
Yeah.
The Fed starts cutting interest rates. Where do they have to go to get to that neutral rate? Now, they say, according to their dot plot, 2.75. But market measures of the neutral funds rate is closer to 3.5%. And as recently as maybe 3 weeks ago, they were near 4% on some of those market rates. So the market's saying, look, you only need to cut rates maybe 5, 6, 7 times in order to get to neutral. So when the market is pricing in 8 rate cuts for the next year, they might already be assuming they're going to go too far and they're going to go into ease territory, which gets me back to my whole argument about maybe a spurt of inflation again to 3.5%.
I do think that there's a real interesting question. What is the right rate? The Fed's been ticking up that neutral rate in their estimates. They were, I think, as low as 2.5, saying 50 basis points real Fed funds and 2% inflation target gets you to 2.5. They've ticked it up towards 2.8. We think it's probably 3.5 at a minimum, but there's a real good question of like, what is that neutral terminal Fed rate when they're not too hot, not too cold, just right, equilibrium? Where do you think that?
Yeah, I think it, well, to answer the question, I think it's closer to 4%, maybe 3.5 to 4. But you're right that the Fed has always used this 2.5% number. Where they came up with the number was that their target on inflation is 2, and then they put in a little bit of a little extra on it, 50 basis points, because nothing's perfect, and that they arrived at 2.5. I think that the number is probably, the inflation target is closer to 3, and maybe they should be 75 or 100 basis points on top of that number, which gets you close to 4. Now, what's interesting about this is, as that number has started to move up, and so everybody knows, every quarter, all 19 Federal Reserve officials fill out what they refer to as the dot plot. And one of the questions they ask is, what is your long-term estimate of the neutral funds rate or the long-term rate? And that median, or that of those 19 members, has moved up from 2.5 to 2 3/4. When Chairman Powell was asked about this at the press conference, he kind of backpedaled. All of a sudden, oh, it's just a theoretical exercise, and it's kind of an interesting thought process, but I wouldn't look into it any more than that. And I was like, well, yeah, because if you really thought about it, what you're suggesting is either the market has more risk because we're still at 2% inflation, we have to put in a higher premium on top of that, or you think you're not getting to your 2% target, but you're not ready to kind of admit that out loud. So we'll just say it's a thought process type of thing. But nevertheless, that number's moving up. The market's estimate of where the Fed should be putting interest rates is higher than that number as well. And that gets me back to why, again, is that important? Because if the market thinks the Fed's going to cut 8 times in the next year, and they wound up doing that, there's a good argument to be made that 1 year from today, if they do that, they're too easy then, and then you could be looking at inflation.
Hello, everyone. Permissionless 3 is coming to Salt Lake City on October 9th. The event for crypto natives is heading west, and we are bringing the biggest names in crypto together for an insane, can't-miss event. Hear from more than 200 industry titans, including Balaji, Mike Novogratz, and Dan Tapiero. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups and L2s, institutional adoption, and of course the November election that will be right around the corner. We couldn't be more excited about this event. Get your ticket today and make sure I get some bragging rights by using my code FG10 to get 10% off. That's FG10, stands for Forward Guidance. I want to see you there. Do it. It's going to be at one of the most beautiful places in the United States, and everyone's going to be there. Van Spencer's going to be there. Jim Bianco's going to be there. Jan Van Eck's going to be there. So what are you waiting for? Get your tickets now by clicking the link in the description and use code FG10. Back to the episode.
The market thought they were going to cut 7 times coming into this year because they moved 1 dot last year, and they got very excited in November. Oh, we're going to do 6 or 7 cuts. And now we haven't done any. And the market still had a very good year. But part of it was like, hey, they showed flexibility. If we have a recession, they'll do something. Now the question is, unemployment's ticking higher. Is the balance suggest that they should move slow and deliberate? They have this slow and deliberate. We like to tease out what we're going to do at the next meeting versus, hey, if the risks start bouncing towards let's just get to neutral, moving
Right.
quickly.
By the way, they refer to that as forward guidance, something Jack might know a little about.
What do you think, Jack?
So the Fed you said the Fed likes to be slow and deliberate. They definitely like to be deliberate, and they like to let the market know they don't like any surprises. But I think they could be fast and deliberate. So if it's necessary to do 25 basis points every single meeting, or even something higher, which is not my base case, then I think that the Fed is ready, willing, and able. To be honest, going into this market, thought that going into this year, I should say a few months ago, it was my base case that the Fed would want to start its first 25 basis points at December, just because it's nice and clean after the election. So not only are they not political, they're not even being seen as being political. I think the economic data has slowed to a point where at least the market believes that 25 basis points at least is coming in September, and the Fed hasn't pushed against that. So that means it's probably going to happen. I want to just, so I've made the point, many others have made the point that more important than what the Federal Reserve actually ends up doing is its signaling mechanism, because if the Fed doesn't cut now, but it says something insanely dovish, then the 2-year rate goes down. That is a net ease of financial conditions now. And that is kind of, I'm talking my book there because it's forward guidance, but I'm actually just going to offer an argument that's against talking my book, against forward guidance, is that so many economically sensitive interest rates are just priced off of the overnight rate or the secured SOFR rate, like corporate bonds, high yield bonds and stuff. That's where the 2 year, the 5 year, the 10 year, the mortgage rate matters. But I mean, a lot of economically sensitive companies that right now are being financed and refinanced by private credit, the gain of private credit, they're paying 500 basis points over SOFR. SOFR's at 5.3%. That's 10.3%. That's a pretty expensive money. So I think it does matter what the Federal Reserve actually does in terms of the short-term, very, very low rate. I want to talk turkey. Dan, you already said you think it's going to be 25 in September, so no 50. Do you think it's going to be 25 in concurrent meetings, or do you think the Fed is going to do a little bit of pause? I'll say I think that the Fed is going to give hints at the September meeting about what they're thinking for November, because they don't like to surprise markets. But what do you think, Jim?
Yeah, the forward guidance thing that the Fed does, which you might know something about again, is simply the Fed likes to tell you what's coming and wants you to be prepared for what's coming. And you're right, going back to something you said earlier, Jack, that they want to be kind of slow and methodical at what they do. They want to be slow and methodical. But the last two cycles, when they started raising rates in 22, they eventually got real quick to 75 basis points a meeting for 4 meetings in a row. And when they cut interest rates in 2020, they went from 2 3/8 almost to 0 within a matter of like 2 or 3 weeks, when they started to realize the gravity of COVID. So they always want to be slow and methodical, but the last 2 times they've been anything but that. So that the door could definitely open depending on how the data really starts to play out. But I don't think they want a surprise. But I also would emphasize again something I said before. A week from Friday, so that would be the 23rd of August, is the Jackson Hole meeting. And that is considered to be probably the most important speech the Federal Reserve Chairman gives every year. And he usually uses that meeting to kind of put in a frame for like a long-term view of where he thinks things are going. And that would be the perfect opportunity for him to address this. What do we do after we cut in September? Are we going to go every meeting? How much are we going to go? What are you thinking about? That's where I think we're going to get the real clarity on that kind of trajectory for the Fed.
Well, Jimmy mentioned, and Jack, you brought up politics, how that's going to factor into the Fed. If there's 2 topics that are happening on these fishing boats in Maine and around the decks here, it's what's happening in the economy, what's happening in politics. As you've heard all the conversation we've had just in the last 24 hours, any new insights on what's happening in the election that you've taken away from the conversations here?
Well, I'll start, and I'll say that, no, the insight that I'm taking away is everybody is still trying to process what's been happening, because it was only 3 weeks ago we had a different set of candidates in the election. And then we got the new candidate, we've had a change in the polls, and people are trying to process if these changes in the polls are a reaction to a switch in the candidate or some kind of a sea change that would suggest something a little bit more permanent. But I think what I found that was most interesting about the comments that I've heard is, and I agree with this, is what does it mean for financial markets? What does it mean for the stock market or the bond market or the dollar that it's going to be Trump or Harris? And is there a Trump trade or is there a Harris trade? And the answer is no, there isn't one. that it seems like the markets haven't made up their mind if one is good or one is bad. Now, sure, you could drill down to individual stocks, find prison stocks or something like that, that Trump's a law and order guy and that they would do better. But that's not at the macro level. But at the macro level, I don't think you're really seeing anything in the markets that suggests that they are at least now expressing preference. We still got 85 days that could be a preference expressed going forward from here. And that's maybe because everybody's still trying to figure out, because we've never switched candidates out this late before, how this really is going to affect the race.
The betting markets in just the last week since we've been broadcasting seem to have really given Kamala a bump. It seems like she's surged in the poly market betting markets that one of the betting sites that I follow on the election odds. Obviously, you need all three between the Senate, the House, and the presidency to get new reforms on. What is taxes the main issue to you for markets, or what are the other key issues?
I'll say that taxes are an important issue, but so is regulation and so is spending. The argument that can be made is to what is one of the things that has led inflation. Here we are, whether or not it winds up going below 2% or not, but the fact is that here we are in the second half of 2024, we're still at 3%, when it was in early 21 that inflation started to move up. So we're now approaching well over almost 3.5 years that we've had this inflation. One of the arguments you could argue is it's been high levels of government spending that has been pushing prices higher, all that demand for goods and services by the government. So that is going to be an important issue in trying to determine where it's going to go. In addition to taxes, which Trump wants to cut, the perception is Harris, being a Democrat, would probably want to keep spending at these levels or higher. And then there's the deficit. And that's where I think the markets are kind of confused, because I think the markets are saying if Harris wins, we get stronger spending and we get a big deficit because we got to finance it. If Trump wins, we get tax cuts, we get a bigger deficit because we got to finance it. So we get either a big deficit or we get a big deficit, and that's why the stock market, the bond market, and the dollar are not really, at least yet, showing a preference of one candidate over another.
Yeah, one of the few things I can say with confidence is that the deficit will remain high regardless of who is in office over the next 4 years. I guess it does depend on Congress, but I do agree with Jim that there are no obvious macro trades in stocks, bonds, currencies. I would have thought that Trump would have been slightly more bearish for the dollar, but I was on a boat with a gentleman today who very well steeped in currency. He said actually that's not true, or if anything, it's the opposite. I will say, I think when Trump first got elected, the night of his election in 2016, if I remember, the S&P futures, the stock market futures, crashed, and subsequently it was before COVID, a pretty good stock market for
not only did they crash,
market, yeah.
but by the next morning they were already back up on the day, and the market went straight up right after that.
Right. So it's really hard to predict. I'd say no one really knows. Jim, exactly a year ago, I was interviewing you and Sam Rhines. I asked both of you, which do you think is going to outperform, stocks or bonds? And you both said confidently stocks would crush bonds. And of course, that has been exactly the case. And it's always easier to assign a reason afterwards, but it's because inflation has fallen, but real growth has just exploded higher as inflation has fallen more than nominal growth. And for the AI boom, the AI hype cycle, however you want to call it, has helped as well. In Camp Kotak in 2025, from now until then, will stocks or bonds do better, and why?
This time, yeah, the one caveat, that did work out that way, but the caveat I would give you on that is that AI hype cycle really helped to push the averages like the S&P higher. If you looked at the Russell 2000, I think it was flat from where it was a year ago until about 3 weeks ago. And then it finally started to move in this big rotation trade around 3 weeks ago. Going forward from here, if we're going to go in a rate cut cycle and we are going to see some stimulus and we get the inflation that I'm thinking, I'm going to say bonds are going to be a better performer than stocks over the next year. And I'm going to say that might be because I could see with the valuations in the stock market now, and if I'm right about this inflation thing, they're kind of where they are right now, like a zero return. And bonds, yeah, the interest rates go up, but you're already starting with a 4 or 5% coupon on a bond, depending on if you're talking about a corporate bond or a treasury bond. And so that will cover a lot of losses. So I would argue to you that that's where you could definitely see the switch now, that bonds might have a period where they're going to do better. They haven't for the last couple of years, but maybe now going forward they will.
I'm going to try to answer that with also a pivot in the question, because the 1 year uncertainty and the volatility in one given year, it's so hard to predict what happens in 1 year. If you zoom out to like, what are these things pricing for the long term, sort of on brand for stocks for long run? Yeah. If you took the S&P 500, you got a little bit above a 20 PE. So you're talking about a 5% earnings yield. That 5% earnings yield is a real return that we look at sort of as a long-term expected return. You add 2 to 3% inflation, you're looking at 7 to 8 nominal returns for the S&P 500 from where you are today. For Jim's side, let's say Jim's the bond guy. I'm the stock guy now. But you got stocks and bonds. So bonds at 4, to get a 7% return, we've got to get the rates to go down by a lot over the long run.
Yeah, if you start with the assumption that you're going to get an 8% return in the next 12 months, I'm looking at the stock market.
I'm doing a 5 to 7 year number. So this is like 5 to 7.
Right.
The 10-year tips is 2. So just if I did comparable apples to apples, 5-year real yield on S&P, 2 on tips. So you got a 3% equity premium. Now people say it's not as good as we had. Equities are definitely not anywhere near as good as we've had the last 15 years. You had 5% median for the last number. It's now down to 2.5 to 3%, depending on the day.
Right, and I'd also point out too that the stock market bottomed in October of 22. Mm-hmm. So we're approaching the second anniversary of the bottom. It's up about 80% in a little less than 2 years. So it has had a gigantic run. If you're talking about a 5 to 7 year average, we're way ahead of that right now if you add in the previous 2 years. So a period of, let's call it indigestion, wouldn't violate that rule at all. And in a period of indigestion, then by default, the bond market could go well. So yeah, so my assumption is that 80%, 2 years, high valuations, maybe a pickup in inflation. This is the pause period for the rally in the stock market, which is why I think bonds will maybe have a running chance at, for the first time in about 4 years, beating the stock.
So in over a 1 year time period, bonds could beat stocks. Jeremy, I think what you're saying is over a long enough time horizon, stocks just crush bonds because they grow their earnings and they reinvest the capital, whereas bonds, you just get the coupon. And if interest rates go down, you get capital appreciation, but how far can that go? Well,
and now Jim has a view that inflation is going to be structurally, not to put words in his mouth, but you tend to think that inflation is going to be longer, stickier, and you want assets that are real assets in that, for things that protect from inflation. And we actually say stocks are real assets. You have the plants, property, equipment, IP. Companies grow their earnings and dividends over time. They raise prices. They pass it along in price hikes, and you get earnings that tend to grow with inflation. And so that's why at a 5% real yield, that's how we tend to look at the equity premium as the sort of best long-term inflation hedge. People look at real estate, gold, other things, but we like stocks for the long run for that view. Short run, the Fed's hiking.
And someone should write a book about that.
There's been 1 or 2 or 6 editions on stocks for the long.
Jeremy Siegel, great book.
But it's in the short run, when the Fed's hiking, like in 2022, to start battling it, that's a tough time for stocks. But zooming out over the long run, that's when stocks do really their best work.
But so Jim, in a no-lending scenario, inflation, let's say, goes back up to 4%. There's clearly no recession. Bonds are not going to do great, right? If inflation reaccelerates.
No, they're not going to do great. I mean, they're not going to do great because interest rates will go up. However, I think we got to put the bond market into context, because a lot of people are so chastened about the bond market because of what's happened over the last 3 or 4 years. Interest rates went from 0 to 5%. To get there, you had the worst 3-year period to own bonds maybe in American history. Ed McCrory at Santa Clara University's got data on the total return of the bond market back to 1790. And the worst 3-year period ever was the period ending with 2023, because you went from 0 to 5. Now, I would argue, yes, that was horrible, but the good news is you're at 5 now. You actually have a coupon again that you can start earning. So if interest rates go up, the next period forward from here, you might see interest rates go up, and with a 5% coupon, you might wind up with a 0 total return, not a negative 12 like you had in 22 or in 23. And that's a big, big difference as you start to adjust for that. And then you set up the pace for a decent return on the other side if interest rates go up that much.